Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. Whilst I just let you have a look at the disclaimer, which I'm just double checking that you can see here, of course. I'll just run through what we hope to get through in the next 30 to 40 minutes or so. We'll follow the usual format. So we'll just check out how markets are trading currently. We'll then just have a look at, all the main assets where they are trading at the moment. Really big week ahead of us. Having followed a pretty big week anyway after non-farm payroll, of course, on Friday. We'll just check out how stock markets as well in the US are looking. Before then, just a quick review of those last week's main events. So we'll look at, of course, that US jobs report with the big market reaction that we saw after that, much stronger than expected report, really. We'll also look at the ECB meeting, of course, from last week, last Thursday, as well as the Bank of Canada meeting on last Wednesday. That was, as well as the associated currency pairs, so euro dollar and also the Canadian against the dollar. Before then, looking at previewing these main few events in the coming days. So we have obviously US CPI data. That's on Wednesday, just a few hours before then the Fed meeting on Wednesday evening, UK time. And we also get a Bank of Japan meeting as well on Thursday night. Before then, probably hoping to wrap up if we have time with a bit of UK jobs data actually out on Tuesday. Has been of big importance to policymakers at the Bank of England, but we'll just have a look at that data as well. And then cable, so sterling against the dollar. Okay, quite a lot to get through first of all. Just want to check one thing. If you can bear with me 1 second, because I just want to double check what you're seeing. Hopefully you've obviously read the disclaimer as well. Okay, first up, let's check out how markets are trading currently. Sorry. Sorry about that. Just that delay. I'm just double checking that you can see what I can see. So just a couple of technical issues. Apologies. Hopefully, first up, you've got a gold chart actually, but we're just as I say, run through. Apologies, just checking. Technical issues. Don't you love them? So yeah, first of all, markets really equities. Which I'll get into in more depth shortly. But they are, pretty negative, really, following that strong jobs report on Friday. Poor Asian session, really, and European stocks not looking too great either. Futures, US futures, that is, just checking those. They're in the red marginally. You can see S&P down 0.12%. Earnings focus actually this week will be on Broadcom, actually out on Wednesday. That's a big supplier into the consumer electronics markets, with Apple, one of its biggest customers. So that'll be interesting. French stocks also being watched as well after President Macron called a general election, really, after yesterday's EU Parliament election results. We'll get into that shortly, actually, because that is of interest to the euro dollar, essentially, plus European assets generally, actually. Commodities, metals, they did suffer big declines last week on Friday, sorry. Gold, especially, and that's why I've got the charts here. That was down 3% or so, really. Double blow from that strong jobs report. And also, actually, China news out of China that the PBOC buying phase, which we have seen over multiple months, has paused now. And that really was then accelerated by soaring bond yields, soaring treasury yields, and also obviously the dollar appreciating sharply. We do have the gold chart here. Don't look at it that much. We probably should do. And if you, I should say, if you do want me to check out any other assets that we don't look at that so much, then please do ask in the box. We can try and make sense of those, or at least just give you an opinion on those. And any other topic, actually, of course, please do ask away in the Q&A box. But for gold, yeah, definitely 22.77. That's a key line you can see here. That's the low from the start of May. And really just I put in some fib levels here, but yeah, this is the low of the lower band, and the recent trading after this sort of sharp move higher, really through 2000 and then sort of through 2200 up to those record highs at 2450. But then we had this big sell off on Friday below the 50-day moving average, which is that blue line there. And then, as I say, 2277 key number for gold bugs. Also interesting with metals, copper has given back half its stellar gain seen between February and May. I think we highlighted that a couple of weeks ago, just that very sharp spike higher, speculatively driven really by buyers. And that's fallen back quite sharply. Also interesting actually for oil watchers, Brent crude positioning has fallen to its most bearish in a decade. And that's really interesting to us, obviously, with still underlying rising geopolitical risks still out there. But yeah, most bearish positioning by big players, speculators, and others, most bearish in a decade. Currencies, then, if we just go to those, then we obviously had dollar strength after non-farm payroll, while the euro is falling on really election jitters and really grabbing the headlines. Obviously, that has helped, well, in the euro dollar pair, of course, being helped by a stronger dollar with that surprise upside in the payrolls report. And that potentially then is delaying Fed rate cut expectations, of course, contrasting with the ECB that cut last week. We'll look at that, as I say, in more depth, but just focusing on equities now, just quickly. Just technically, not a lot to say. We did intraday, post an intraday record high again in the S&P 53.75, but we just closed below the previous record high. Still fairly positive, really. I've still got that dotted line in there from that cycle high previously at 52.64. And you can see that sort of held, even though we dipped below it for just a couple of days, 3 days or so. But then buyers stepped in and made record highs, of course. NASDAQ, pretty similar chart. We made another record intraday high, at least to 19,113, but then closed below that record high. Still just, you can see, closed at 19,000. And again, we've got that previous cycle high at 18,464. Interesting then, the Dow, different chart, of course. We highlight this every week. Had a big sell-off. And we've got back to, you can see multiple fib lines in here of this sort of range from the low in April up to the record high, just above 40,000 before then this sharp sell-off. So yeah, we're just struggling around the halfway point actually of this move higher. That's a 38,848. Moved above there on Friday before closing lower. We've got the thick blue line here, which is the 50-day moving average, you can see there. And then that halfway point of this move, yeah, 38,848. Potentially, if we're dipping now below the 50-day, then next support, potentially at the 61.8 fib level at 38,559. And then we've got the lows, recent lows anyway, from, well, end of May, around 38,000, bang on the nose there, bang on the figure. So, yeah, those are the levels in the Dow. Okay. Yeah, interestingly, really with just sort of observations on stocks generally from Friday. Small cap stocks, actually, they lost almost 3% against large caps last week. They suffered the most really from the extended bullishness and, of course, then treasury yields rising higher. Kind of interesting that even though we saw this big increase in yields on Friday after non-farm payroll, there was a sort of relative resistance in equities, if you like. Kind of probably we would have expected certainly to see a bigger sell-off. And if I just highlight the Dow, obviously down 0.22% on Friday, S&P down 0.11%, Nasdaq 0.2%. And yeah, a bit of a surprise, certainly with the rise in yields, and it would ordinarily hit growth stocks especially. And you can see this is the US 10-year Treasury yields. We will say to keep an eye on this really, because it generally should affect other assets as well. You can see the big jump there after this sharp multiple day sell-off really in the last week or so, end of May, beginning of this month. And we got down, we have highlighted this sort of 4.33, 4.35 level, long-term level that if I just pull it back, you can see was that big cycle high from October 2022. So we did move down below there, but yes, acted as support and we've just bounced off it now. And you can see the halfway point of this move lower is at 4.4%, and we're through that as well. So yeah, probably 4.5% next on the radar, and potentially at some point, if yields continue to go higher, then we would think that would affect riskier assets, growth stocks for sure in time. Just on going back to the stocks, I think it's interesting. Somebody pointed out Nvidia, of course, up 32% or so, which is really carrying the S&P 500. And without that, this concentration again in a handful of tech stocks, not the Magnificent Seven really, because Tesla, Apple been struggling slightly relatively to the others, and of course relative to Nvidia. So Nvidia really carrying the wider market, Nasdaq, S&P. Whereas if that was not in those, then certainly the chart may look slightly more like the Dow, slightly more, I would say. Okay, let's go to last week first of all then, and the NFP report. We'll just do a quick review of that. What sort of took our eye, if you like. If you just bear with me 1 second. We'll go back to here. Yeah, here's what we're looking at this week anyway. We've just looked at markets generally and some of the technicals around the US major stock indices. Let's now go to, non-farm payroll and a graphic. Hopefully you like these. These are reviews, the main numbers, of course. We use this as a preview and then now a review, if you like. Yeah, very strong data. Labor market still tight. And really kind of the opposite, really, of what the Fed wants to see this point in the cycle for sure. Headline 272,000, so that beat consensus of 180. And even actually the highest estimate, analyst estimate, really, from all Wall Street banks, really, major banks, that was at 258, the highest estimate. So 272 beating all expectations, really. There were minor downward revisions just to 15,000 to the past 2 months. So nothing like the big revisions we have seen recently. And then average hourly earnings were hotter than expected as well. They rose 0.4%, previously 0.2%. A month on that was month on month, and then year on year 4.1%, previously 3.9%. Yeah, so those were the very hot elements of the report. Should say, though, the unemployment rate, it did hit 4% for the first time since January 2022. So that's up from 3.9% last month, and the low, if you remember, of 3.4% in April of last year. Just on this then, so the jobs report, the non-farm payrolls jobs report is made up of 2 surveys. So the establishment survey, that gives us the payrolls number, but then the household survey, that's conducted separately and used to generate the unemployment rate. And that reported households as saying employment fell more than 400,000, with unemployment rising 157,000, labor force shrinking 250,000. So a much weaker picture. But the markets concentrate on, well, the headline, the establishment numbers at the moment, and really they reacted to that very strongly. You saw that Treasury yield rise 15 basis points in the 10-year, which is a very, very sharp move intraday for sure. And then obviously the dollar has risen as well. And has gone again today on the back of sort of EU worries as well, which we'll look at shortly. Yeah, I've just got pricing in here, which is of interest for the Fed, obviously, with the meeting on Wednesday. So September after this data, anyway, 20 basis points was priced in. That's down to sort of 15 and less now, actually, around 12 and a half, because there's pretty much a 50-50 coin toss bet on a September rate hike, probably just a touch slower now, actually. And then the cumulative number of basis points, so cuts for the year, that's fallen from 49 basis points to below 40 now. I've got in here 49% chance. Yeah, I think that's when I last looked, and pretty up to date actually. So just below a coin toss. And as I say, after the data anyway, total number of basis points for of easing by the Fed by December, 40 basis points. I think that might have moved a touch slower now as well, from 49 basis points before the figure. Just look at a chart, really, is because of an investment bank, actually, ING. They, yeah, just shows you payrolls changes and this jump up from the previous 180, 175, actually, sorry. And then that 3-month average, the orange line, slightly ticking up higher. Okay, that's non-farm. Let's move on to the ECB. I've just got the CPI data charts that you can see here. Really, as expected, the ECB cut rates for the first time since 2019, September 2019, lowered the deposit rate by 25 basis points to 3.75%. Didn't really come as a surprise, as you will have known, and was really one of the most telegraphed or best telegraphed moves, really, in recent sort of central bank history, probably we would say. The main question was whether then the ECB would give any forward guidance and tell us about what they think about policy going forward and what happens next. Within the accompanying statement, the main highlight was probably the Governing Council is not pre-committing to a particular rate path. Furthermore, the ECB reiterated its pledge to keep policy rates sufficiently restrictive for as long as necessary. And then with regards to the assessment of the economy, statement read that despite the progress over recent quarters, domestic pressures remain strong, wage growth is elevated, and inflation likely to stay above target well into next year. We did have the quarterly staff economic macro projections, really. 2024, 2025 headline and core inflation forecasts were raised. And then the 2026 headline expected to print at 1.9%. And then from a growth perspective, GDP, that was raised in 2024 by more than expected, but then 2025 lowered as expected, pretty much. So that was kind of the start of the ECB. Then obviously we had the press conference. President Lagarde really explicitly stated that the central bank was not pre-committing to any particular path for rates. And that really sort of told the message. She was trying to clearly refrain from giving any forward guidance, which was a shame and what we were all looking out for. Her comments during the press conference really pointed to kind of a still needed level of restriction, very high data dependency, what we highlighted last week, and then the fact that one of the members of the Governing Council was against yesterday's rate cut, hawk, and suggested that the ECB has indeed, not yet decided on any next steps. I think interesting as well, Christine Lagarde, she did make the point that the ECB is far from the neutral rate, but then she obviously refused to commit to deciding on rates only on projection round meetings, but noted that policymakers do have more data available at these meetings. So I think it was the question asked about to her whether the ECB would only move on meetings when they have the quarterly economic, fresh, updated projections. And she sort of refused to commit to saying that they would do that or not. Overall, though, market pricing is sort of slightly more hawkish given the lack of explicit endorsement for another near-term rate cut. October now no longer sort of fully priced for a rate reduction. Probabilities around a December cut are kind of coin flip, 50-50. They were sort of 57% or so pre-ECB meeting. We do then had sort of sources commentary. So that is, for those of you who don't know, after the meeting, and I think I highlighted this last week, actually, very interesting. You always get comments from ECB and inverted commas sources via Bloomberg, via Reuters, and this is essentially hawks or doves trying to put their point out very quickly after a meeting. The quicker they come after the meeting, kind of recognize that there is then increased dissension among the governing council, and you can imagine then those two sides trying to put out their arguments very quickly after the meeting. Those sources stories anyway, they suggested that a July rate cut is unlikely. Sounds pretty fair, especially after the meeting and President Lagarde, what she said. And then September was slightly unclear. And certainly the focus is now all on that meeting after the summer rather than any July meeting. I think even Christine Lagarde said enjoy the summer. So yes, probably more than probably, very likely September is the one everybody will be looking at. And I think a source's comment actually came out with a rate cut would be warranted in September, just quoting them, if the ECB's inflation forecast for the last quarter of 2025 remained where it has been for some time, that is at sort of 1.9 to 2%. Okay, let's look at Eurodollar now, which I'll just put up the chart here. And you can see big sell-off. I mean, look pretty positive, and we sort of kind of thought this was just potentially sort of bullish consolidation before then a break higher towards and above 109 up to sort of these highs here. Well, we struggled around this halfway point. Should have been a warning sign potentially. That's the halfway point of this move lower. That was at 108.79, and then obviously big sell-off on the non-farm payroll. And again today, I've left the 50-day moving average in there, kind of not that relevant, you would say. If we just look at, say, the 200-day, interesting. Is that relevant? It's kind of not that relevant because we're just breaking it quite a lot. But yeah, that's a 107.87, and we've just broken down below there, gap lower, really. So very weak, really, euro at the moment. There's a lot of talk, and I said I'd go into this about, obviously, the elections we've had over the weekend. We're now at 1 month lows, and that really is a fallout from those elections and the outcomes. It's resulted in a snap election being called in France, as kind of mentioned, and really then political instability in the EU, adding pressure to the single currency. Leaders from Germany and France faced defeats in the EU Parliament elections. Far-right parties really gaining traction. As I said, Macron, he called a snap election after a pretty humiliating defeat, really taking a gamble about what will happen in those elections. I think coincidentally, just around either side actually of the UK election, so start of July, they have 2 rounds in France. But this all potentially leads to more political instability. It adds to the deficit risk. And that was certainly highlighted as well by S&P's recent downgrade of France's sovereign credit rating. So yes, no doubt getting pressure on the single currency, certainly as well. If we go back to the ECB, that's kind of, well, it's weakened the euro's yield advantage, probably limiting upside. And then, of course, despite that bias that we saw by President Lagarde, kind of neutral, non-committal, but potentially the central bank's rate cut really has lowered the yield advantage on the euro. And possibly then, as they've rate cut already, then potentially that is, of course, a more dovish stance really compared to the Fed anyway. And that potential for further cuts possibly then exacerbates that sort of yield advantage, any yield narrowing that we had seen. For the euro as well, I mentioned, well, there's been slower. If you think about the euro slowing China momentum, so the recent gains in China are slowing, and then the scope for fresh stimulus is potentially more difficult as Fed rate cuts are delayed. We also look at stuff like CFTC positioning. So again, that's just big positioning by the big players in futures. That comes out every Friday, that report. And net longs in the euro anyway have reached their highest level since March. So potentially a warning sign. And then as longs, very longs, if you like, bail out, then that exacerbates the move lower. Of course, then we've had that stronger dollar due to that upside surprise in non-farm payrolls as well. Okay, euro wise then, where are we going to next? Well, we probably have these swing lows here from mid-Feb at 106.94, so just above 107. That would be initial support potentially, and then obviously we have these very strong support really with the cycle lows from mid-April then just around 106. So interesting to see where this goes with bearish momentum pretty strong. Okay, also we had the Bank of Canada last week. Just pull up the dollar CAD chart. They lowered their interest rate by 25 basis points to 4.75%. Move kind of in accordance with markets pricing. That was around above 80% chance of a rate cut. Governor Macklem, he said they have seen further and sustained evidence that underlying inflation is easing and that monetary policy therefore no longer needs to be as restrictive. Also, the Bank of Canada, they didn't rule out that more rate cuts could be on the horizon if inflation continues to head in the right direction. That means the bank actually will be closely watching the evolution of core inflation and remains particularly focused on the sort of balance between demand and supply in the economy. Also, inflation expectations, they'll be looking at wage growth and corporate pricing behavior. It is worth adding that although some are skeptical about the extent to which the Fed and the BOC can diverge, Macklem, he repeated that there is a limit to this, but he said the bank is currently not near that limit. And that perhaps gives the Bank of Canada more leeway ahead, even in the event of a more hawkish Fed. A market's really now pricing in sort of around a 40% chance of a cut already at the next meeting in July. Really with eyes on Macklem's sort of one meeting at a time phrase, I think he used. Fully priced for a September move if they don't go in July, while, of course, the Fed isn't really fully priced until the end of the year. So you can see dollar CAD, that's rising now. This divergence sort of accepted by Macklem, by the Bank of Canada, and potentially a possible rate cut. Pretty good odds still. Not around 40%, as I said. I think that's still the case. So you can just see dollar CAD, so CAD weakening, dollar going higher. And really, just pull this back somewhat. You can see long-term highs above 138. Which we struggled at over recent year or so. So just watch this level here, and then probably 138.37, 138.46. Is it the high? Yes. So watch that as potential resistance to this sort of break from pretty choppy markets, at least in that is dollar CAD. Okay, this week, let's go to now. There it is. Let's go to now, well, US CPI. We'll look at the Fed, of course, and Bank of Canada. Here's a preview of the main numbers for the CPI data out on Wednesday, as I say, just before the Fed meeting. Headline expected to rise 0.2%. Previously, that was 0.3% month on month. So that gives us a year-on-year figure of 3.4% in the headline. Core, that's expected to rise 0.3% month on month. And then that means a 3.5% rise year on year. April CPI outcome, if we just cast our minds back, actually, that provided a kind of reprieve for the market following re-acceleration in services inflation all across the first quarter of this year. Of course, 1 month does not make a trend. Obviously, it can certainly start one. And really, it's important for market expectations that May shows further evidence of disinflation towards the 2% medium-term target. Prices for core services and housing services, they'll be closely watched. With services inflation, the area that is keeping headline inflation sticky. Helping in May, economists reckon, will be the reversal in oil's Q1 2024 gains, and core inflation potentially meant to show some evidence of progress. So you've got strong kind of smaller components, subcomponents like I think motor vehicle insurance expected to plateau, and then shelter, the big one, expected to decelerate further. It is important to remember that goods inflation is kind of already absent, and then services components pretty benign. And indeed, excluding shelter, which is sometimes what you might see, annual inflation is already back at target. So those will be the elements to watch if you do look out for the detail in the report. Speaking in mid-May, Chairhead Powell, he said that although Q1 was notable for a lack of progress made on bringing inflation down, the Fed, he believed, had made real progress on the prices front. He urged patience and allowing time for policy to do its work. Although certainly restrictive policy may take longer than expected to do the job that it's meant to do. Yeah, that's the CPI data. So you can just see where the sort of Fed's target is. Of course, 2%. I've just got pricing in there. July pretty much off the table now. Here's a chart of those CPI numbers. So the headline, the orange line, sharp fall, of course, from just above 9%, I think it was the high, but just stalling now, that disinflation process. Core as well is ticking lower. So shelter costs there, really important. And then oil costs, of course, important in the headline, if you like. There's a 2% target. And then you've got actually on here as well, core PCE. We went through that last week. Actually, the Fed's more favored inflation gauge just because it's a broader, looks at a broader section of the economy, businesses and consumers. So yes, just a chart with those numbers on. We move now to the Fed meeting, of course, just a few hours later, as I say, fully expected to leave rates unchanged at 5.25% to 5.5%. That would be the 7th straight meeting. In each of the policy statements issued so far, actually, this year, the Fed have said it does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. That's the forward guidance. That's the key piece, which is expected to be retained in June. So just watch out for that initially. In May, actually, just going back, Powell, he did emphasize that the inflation data so far, as I've kind of mentioned in 2024, had not provided policymakers with that greater confidence. So that will be interesting to see whether there's any changes there, tweaks to the statement language potentially or not. As is normal 4 times a year, so quarterly, we do get the summary of economic projections and then the dot plots. Really, a lot of focus will be on that dot plot. So that's the Fed's basically median assessment for the appropriate Fed funds rate at the end of 2024. So basically how many rate cuts the Fed is penciling in for this year. The March forecast, they narrowly projected 3 cuts for this year, if you remember, but there are risks now, certainly, that the updated projections could reduce that view to, well, probably 2 reductions or possibly one. One would be the outlier. I think two is pretty much consensus, more or less, but one definitely the outlier. And that essentially means that the 2024 median dot should move higher, really, to imply either 25 basis points, which is 1 cut, or 50 basis points, which would be 2. So a lot of expectation, a lot of focus on those dot plots for sure. As for growth and inflation forecasts, well, in the March SEPs, that's a summary of economic projections, the Fed projected that headline PCE inflation will fall to 2.4% this year, and core seen falling to 2.6%. Just for your reference, the April data that printed at 2.7 and 2.8%. And the summary of economic projections did not see inflation returning back to the 2% target until 2026. All this means then that the Fed probably will be tweaking its inflation forecast modestly, possibly growth, but really, interestingly, sort of not or significant changes, not really that predicted. Powell then, he may put greater emphasis on the risks to the outlook, as upside risks to inflation are possibly fading while downside risks for employment and activity grow. Although obviously tallying that with the recent non-farm payroll report, of course, will be interesting. And of course, there will be much focus as well, as always, on Chair Powell's press conference after the statement. We just have what markets are expecting currently, and certainly now much less than 50 basis points of rate cuts for 2024. If we now pull up the dollar index chart, so that's the DXY chart that you can see here. Remember, I always tell everyone, but I always think it's important. 56% or so is the weighting of the euro in the DXY index. 6 currencies in total, but by far the biggest weighting is the euro, just to remember that and remind you. Really interesting then, we had this sell-off. The dollar was looking weak. This long-term trend line was broken, but then we sort of tracked sideways on a fib level, just below the 50-day. But then with the buying after the non-farm payroll report, and then obviously today as well, we're back above that bullish upward trend line. And initially, well, we have this fib level here, 105.25, but then potentially we go up to sort of 106, and this very strong resistance where these recent highs were in April and the very start of May, you can see there. Certainly then, just to go back, CPI number, of course, then the Fed could be volatile, certainly if you got, say, a softer inflation report, but then maybe a more cautious, slightly more hawkish hold from the Fed, for example. So definitely volatility ahead, we would say. And yeah, the technicals on the dollar, interesting because of that breakdown, but then the sort of false break because we're now back above that long-term bullish trend line. Okay, let's just quickly go to finally, we'll wrap up with, actually, just bear with me 1 second. I'll pull up dollar yen when I can find it. Apologies. And put you back in. So dollar yen is here. Of course, we have the Bank of Japan policy, the announcements expected to maintain policy settings. There's only a small chance, I think around 15% or so, of a 10 basis point hike. First hike really fully priced in by the September 20 meeting, but there is focus on the July meeting, certainly as a possibility for a rate hike. Focus for this meeting probably maybe just on sort of commentary around balance sheet policy, really, future pace of JGB purchases, that's Japanese government bond purchases. But in any event, data-wise, well, last month's national core CPI figure for April. That printed in line with expectations, 2.2% cooling from 2.6. GDP has been a cause for concern. There was a contraction in Q1, which economists have sort of argued presents a challenge for the Bank of Japan, which has been carefully sort of paving the way for future rate hikes, really. Household spending, that makes up over half of Japan's GDP. That has been a dragging factor. And more recent housing spending data also kind of paint a slightly more fragile picture. As for recent commentary, board member, Nakamura, he said that based on current data, it's appropriate to keep policy intact for the time being. And increasing interest rates at this stage would be premature. Governor Ueda, he said the Bank of Japan proceeding cautiously on interest rates. Bank of Japan likely to want to see likely to see, ordinarily, no, sorry, this is actually me saying this or us saying this. So Ueda sort of saying the Bank of Japan proceeding cautiously. For us, then, Bank of Japan probably wanting to see wage hikes in wage data now, and also then confidence, consumer confidence turning better, and then really solid business investment trends to then really seal another hike. Well, for sure in July, if not then September. Dollar yen, you can just see we still have in these fib levels from this sort of yen intervention levels with the high and low. The halfway point, we're now sort of moved above that as the dollar strengthens. That's a 156.03. Next fib level, 157.01, and we're just struggling around there, which is kind of these highs as well. So really be interesting whether we can break these or not. 157, sort of 67, 157.71, these highs, because then we're certainly getting back into sort of intervention territory. Just interesting price action, really, with all this dollar strength, mainly, well, for sure, concentrated in the euro. You can see that there. If you can just see my sort of watch list here, euro down 0.45%, cable sterling only down 0.03%, and well, dollar yen up 0.14%. So yeah, all concentrated in the euro, really, the dollar strength, and you can just see sort of very small range actually in dollar yen, and just struggling around 157 at the moment. I did say I'd briefly look at the sorry, I said I'd briefly look at that sterling data as well, and I'll just pull up cable. It's always good to look at the charts. Expectations for the jobs data, actually, which is out tomorrow in the UK. Unemployment meant to hold steady at 4.3. And then it's wage growth, which has been, of course, a focus for the MPC. That's expected to cool to 5.6% from 5.4%. And then the ex bonuses measure, gets more of a focus, holding steady at 6%. So that's still hot, still an issue for the MPC. Although I should put a caveat on this, especially with the jobless rate, actually, there is increased skepticism about some of this data and the validity of it. Certainly, though, 6% or so is, as I say, still way too high for the MPC and the Bank of England. A cut's really priced for this month, very small chances of that happening. And a full reduction really not priced until much later on in the year. So yeah, just watch out for those jobs figures in the UK. For cable, you can see we've just struggled at 128, so that is a barrier which you can see has been previously. Now we're just up down to sort of just above 127. You can see sort of support here just below 127, around sort of 126 late 70s, 126.80 or so. So that'll be decent support. Otherwise, we lose that, then we're going back down to sort of 126 potentially. Much will depend, of course. Yeah, wage figures, and then of course Wednesday's big day with CPI, US CPI, and then obviously apologies. Then of course from the Fed. Can't quite get my Zoom, which has been playing up most of the morning, which is very annoying. So apologies for that. I'll wrap it up there. Please do follow us on social media, which is the slide I was obviously trying to get to. Apologies. Yes, a lot happening. And just to make you aware, we will also be doing an additional webinar actually on Thursday. So after the CPI data and the Fed. So we'll be reviewing that data and what Chair Powell and all the dot plots and the summary of economic projections, what they all mean for markets. We'll check out the reaction, the initial reaction on the morning after, if you like, UK time anyway, and then look at a few setups, hopefully trade setups, and see how currencies and major markets have reacted to that big day on Wednesday. Okay, take care out there, and we'll speak to you later on in the week. Okay, thanks for watching, listening, and take care.